Um, we're glad to have you join us for this webinar, the first of a series. My name is Grace Namugambe, and I work for the African Women's Development and Communications Network, FEMNET, and together with the Global Alliance for Tax Justice, Latindad, and Action Aid International, we are delighted to welcome you to this webinar, the first in a series, which we've themed Framing a Feminist UN Tax Convention. And as part of these webinars, what we are seeking to do is to create a collaborative space for feminist and women's rights advocates to jointly analyze key tax issues that are currently part of undergoing negotiations under the UNTC, and to develop a common understanding and craft shared advocacy positions. We also intend to strengthen participants' knowledge and capacity to engage with the UN Tax Convention process. For this webinar, our focus will be on the fair allocation of taxing rights, and we believe that this will be a space for us to have a common understanding, but also frame a joint and common position as we head to the negotiations later in August. So I'll quickly start just by sharing a brief background before I hand over to Zandile, who will be taking us through the fair allocation of taxing rights. Okay. So just in brief, and to make sure that everyone that we're all moving together. For those who might be joining us or learning about this for the first time, the decision to develop a UN tax convention was agreed on in 2023, and the negotiations are ongoing, have been ongoing, and will continue until 2025. And we believe that this is a historic moment because it is bound to shift tax governance from OECD dominance to a universal UN framework that provides a seat at the table for everyone, especially when it comes to making decisions when it comes to international tax policy. So why is this convention relevant? One of the things that we've seen in the past is that many African countries, and countries, especially those part of the global majority world, have not been able to implement international tax standards. Sometimes because these standards had not been developed with the capacity constraints and the context of African countries and global majority world countries in mind. And it's also important for us to note that additionally, the primary international rules, such as the Nexus rules, had been rendered outdated. When we look at, say, things like digitalization and globalization of the economy, these had not been put into consideration in the design of earlier rules. And also, in many instances, we see that international tax rules have been developed in non-inclusive and non-universal spaces where the richer countries tend to monopolize the rulemaking process and impose their standards on African countries. And as a result, many of these sentiments were taken note of. And in 2023, Nigeria, on behalf of the African group, tabled a resolution at the UN General Assembly for the promotion of inclusive and effective international tax cooperation at the UN. Next slide. So this is just a slide showing the timelines of the UN tax convention process. As I had mentioned earlier, in November 2023, the UN General Assembly adopted a resolution and established an ad hoc committee to negotiate the terms of reference to guide the negotiation of the framework convention. And later in February 2024, the ad hoc committee had a session, and in between April and May 2024 was the first substantive session of the ad hoc committee, and later to discuss the draft terms of reference, and later, to discuss what would appear in the draft terms of reference, and later in July 2024, they were able to release the draft terms of reference. In July of 2024, this same group was able to have a session during which they adopted the terms of reference, although by a simple majority. And in December 2024, the TORs were adopted by the Second Committee of the UN General Assembly. And this also led to the establishment of the Intergovernmental Committee. Since February 2025, the negotiations have been happening, and the text of the UN Framework Convention is still being negotiated. So far, there have been four negotiation sessions, and this year in August will be the fifth negotiation session. So this webinar is one of those spaces where we hope to have more feminist organizations and allies on board to champion the use of a feminist approach as we advance the UN Tax Convention. And just to take us through the session today, I'd like to invite Zandile, who works with the Tax Justice Network Africa. And Zandile is an admitted legal practitioner with a master's degree in taxation and is currently focusing on reforms on the global tax architecture and advancing equitable tax systems. Doing this while working at TJNA. Zandile, the floor is yours. And just to note, in case anyone has any questions, please feel free to post those in the Q&A box. We will be responding to them during a later time in the session. Thank you. Zandile, over to you.
Thank you so much, Grace, for the background and just the overview of what has been happening at the UN Tax Convention and the negotiations. But for the purposes, I think, of this meeting, I should just highlight that in as much as we refer to the African group, we understand that this work, is very global. And right now and today in this meeting, we've got people from, all over, besides Africa, but also from Latin America and, and other regions as well. But then in terms of my positionality, I'll be speaking and drawing examples from the African context, and hopefully you'll be able as well to draw parallels with your own country contexts from what I'm going to be presenting on today. Okay, I think the first aspect I just want to discuss before we get into the actual conversation, which is the fair allocation of taxing rights. But first of all, we need to understand why we as feminists, we need to care about international tax rules, right? And the first thing we need to understand is tax law is a political thing. It's not a technical subject, although people believe that, it's technical when you're going into the negotiations and the conversations. They're technical conversations, but we've got critical tax theory or a feminist tax analysis, which believes or which affirms that tax law is political, right? So we need to be able to understand the gendered impacts of taxation going into the, when we want to understand international tax rules or the connection between international tax rules and our domestic or national tax systems. And there, under the gendered impacts of taxation, we need to understand that we've got so many domestic taxes, such as VAT, such as informal taxation, such as pay as you earn, that are very regressive taxes, mostly because they disproportionately affect or burden women more. So you might find that if you're looking at the tax legislation, if you're looking at your income tax or your VAT, from just a glance of it, you will not be able to see some of the hidden biases or the implicit biases which are in those pieces of legislation, unless you really go deeper and use a feminist tax analysis or a critical tax theory analysis to be able to uncover some of those hidden biases. I'll give an example here, just a quick one, to say, for example, when you look at consumption taxes or VAT, you might just say, okay, fine, it's okay that there's a rate of 14%, and then they increase the rate maybe to 15% or 20%, depending with what your national tax legislation says. But then if you look at the statistics or if you look at the data, it will tell you that women consume more compared to men, meaning that when it comes to consumption taxes, such as the value-added tax, there might be like a disproportionate impact or burden there. So women don't have the same ability to pay, or they don't have the same ability to bear the tax burden like men do. So therefore, it becomes very political. And then also we need to understand the redistributive potential that tax systems have. So in addition to our governments imposing certain taxes, there's also a need to have progressive tax systems. So we don't want the regressive tax systems. We want tax systems that are able to fund the public services that are very critical for women, such as health, such as education, childcare, and so on. And then connected to the redistributive aspect of the tax system, we need to be able also to understand or to have a feminist tax analysis when it comes to domestic resource mobilization. So our jurisdictions or our countries need to be able to raise sufficient revenues before we can talk about redistribution to public services. And then all of these conversations regarding the gendered impacts of taxation or regressive taxes, DRIM, domestic resource mobilization, and the redistributive potential of the tax system, they all can be addressed through the structural critique. So what we're currently saying in this space or in terms of this work is that if you're not taxing the right entities, our governments have to raise revenue, right? If they're not taxing the right entities the right way, that means they have to find those revenues from other tax heads or from other ways or from other groups within the tax system. So if they can't tax multinational entities the right way, then that means they'll have to introduce regressive taxes. They'll have to find other people to tax to close that revenue gap. So that's why it's very, very important to be able to understand the connection between our national tax systems, domestic resource mobilization, public services, and also our needs as women within the space. So I just highlight there that what we're just trying to achieve in terms of the work on the UN Tax Convention, we're trying to ensure that we have a framework that redistributes power, resources, and opportunities. And we were talking about power, resources, and opportunities, especially for women, so that we don't have to have these conversations around VAT. We don't have to say, okay, we want health, or we want education, we want childcare support, when there's no, then our governments are telling us that, no, but we don't have the revenues for that because they're not sufficiently collecting the taxes which they're supposed to tax, because they were operating in a system that has unfair tax rules and just tax rules. So they are just in the next slide here, I'm just trying to draw a picture of why it's important, or how the international tax system comes into play, right, in terms of the national and the domestic as well. So I highlight there, most of you might have heard of Kimball Crenshaw, what she says regarding intersectionality, right? She says that consider, I'm just going to move this. She says, consider an analogy to traffic in an intersection, coming and going in all four directions. Discrimination, like traffic through an intersection, may flow in one direction, it may flow in another. If an accident happens at an intersection, it can be caused by cars traveling from any number of directions, and sometimes from all of them. Similarly, if a Black woman is harmed because she's in the intersection, her injury could result from sex discrimination or from race discrimination. So basically, if we try to use this analogy in the tax system, right? You see that a woman is standing in the middle on crossroads or at an intersection. Then colliding with her, we've got direct tax policies. We've got indirect tax policies. That's your regressive taxes, your VAT, where women are having a higher burden on basic goods and services. And then we also have issues to do with public spending and tax allocation, where we're saying that budgets are constantly ignoring women's priorities, right? So there are misaligned priorities and fair allocations of public resources. And then we also have issues to do with tax administration and practice, where women are excluded from decision making in the tax system. And then we also have, the direct tax policies that don't recognize women's unpaid care and domestic work. We also talk about property and inheritance tax biases there. But hovering above all of this is the international tax system. So for us sometimes to be able to understand some of these issues to do with, okay, fine, why are women having a disproportionate burden on their income and consumption? We need to understand that our governments are trying to raise revenues, but in trying to tax women, we have the situation where there's a lot of gender inequality and a lot of assumptions around women and men having the same ability to pay because our circumstances are not being considered in the tax system. So for our governments to be able to give us the public services that we need to fix the international tax system, which will then give our countries the right to be able to tax the right taxpayers and not burden a certain group within the population. And then I think this is what then brings us to the international tax discussion, to say what aspect of the international tax system is problematic right now and where should the conversation really start from. And this is where we talk about some of the structural issues within the global tax architecture, right? We talk about the outdated nexus rules to say, look, source countries are being blocked from taxing without physical presence. And then those countries that have digital service economies that really rely on that, they're also disadvantaged because when an entity or when a multinational entity or corporation doesn't have physical presence in your jurisdiction, it means that your countries are limited in terms of how much they can tax that entity, leaving it to then rely on other forms of taxes to cover up or to gain those revenues. So when it comes to the nexus question, we're basically saying this is a link that's required when a multinational entity or business is operating like in a foreign country. And then when it comes to corporate income taxes, for example, because we're talking about multinational entities, physical presence is what is considered for our countries to be able to tax. And then under that is what is called permanent establishment. So if a company, a multinational entity doesn't have like an office, doesn't have a branch, doesn't have like a warehouse in your country, then your countries cannot tax that specific entity. So that's where you'll find other countries introducing what are called digital services taxes. This is basically now a virtual nexus to say, okay, we understand that you're not operating or physically in our jurisdiction, but we still want to tax you. So they're trying to go around that, those international tax rules that were designed a long time ago to introduce new ways or to cater for the new ways of doing business so that our countries can be able to tax those multinational entities that are not paying their fair share. And then in terms of the other thing that's problematic in terms of the global tax architecture, right, it's issues to do with withholding taxes. So you find that most of our jurisdictions some of them don't have digital services taxes. So what they do is then have what are called withholding taxes in the income tax legislation. So But then we have our double taxation agreement. So Zimbabwe, for example, or Kenya and the UK, for example, will have an agreement that, look, we understand that you have a right or a sovereignty to withhold certain taxes. But then they bring in an extra burden on Kenya to say, but can you reduce the rate at which you withhold dividends, interest, and royalties? So instead of withholding 20%, that is legislated in their domestic legislation, you'll find that now Kenya can only withhold maybe 5% because they've agreed to it with the UK. So that's a very problematic thing, and I'll talk about it later when I do my presentation on double taxation agreements. And then we also have the issue to do with profit shifting, where we have multinational entities that come in to manipulate transfer pricing rules. So you find that when they have like a subsidiary in our countries, you find that subsidiary might not be reporting the correct profits because all of the profits might be recorded in another jurisdiction, meaning that what our countries can tax is very difficult to be able to find. And also when it comes to some international tax rules, such as transfer pricing, you find that our countries are a bit behind when it comes to the capacity which they have to work with those rules and to understand those rules and to apply them in their specific context. So the global tax architecture is also helping to promote profit shifting. And then the non-inclusivity of the rules of the governance system. I think Grace touched on that to say, look, right now we're operating in a system where we have the OECD framework and we've got the UN framework. Most of our countries in the global south or developing countries, they don't have a seat at the table. So these rules are made by another jurisdiction or by other countries, and then we're forced to implement them, which is a very, very big problem, because then how do you know if whatever is being agreed to actually works for your own country? So this is why we're now at the UN tax negotiations and having the discussions on reforming the global tax architecture because of some of these outdated rules and problematic issues. So within that, there's what we call the fair allocation of taxing rights. So if you look at the current text, or if you're following the negotiations, you'll constantly hear the referral to, we need a fair allocation of taxing rights. So this is the political heart of the convention. This is the heart of the convention, and every other article will dance around that or will be working around this specific thing. So if you want to reform the global tax architecture, this is where the conversation begins. So when I talk about fair allocation of taxing rights, what we're talking about is how two countries, I'll keep referring to the same example, Kenya, for example, and the UK, how they divide the income or the revenues that a multinational entity that is operating in Kenya and headquartered in the UK is taxed. So if there's a dollar, basically, that if that company has a dollar, we're asking ourselves, who is supposed to get a greater share of that $1 that company is earning from the operations that they have in Kenya, despite the fact that they're headquartered in the UK, for example. So we're deciding whether jurisdictions such as Kenya, which is a source jurisdiction, basically it's importing, or this is where the markets are allocated. So although the country is headquartered in the UK, when it comes into our developing country jurisdictions mostly, we're giving them a market, and we're giving them an opportunity to invest in whatever is in Kenya, and then they take the profits or they take the revenue back to their countries. And we're saying, no, we need to be able to divide that dollar revenue or that income or those profits fairly between the two countries. Which is what we're basically talking about. But when it comes to what feminists are advocating for in terms of the allocation rules, and based on our submissions, like in the last from the last session and the last 4 sessions, is we're trying to prioritize source taxation so that we strengthen developing countries' fiscal space. And I'll keep saying this. If we're not taxing multinational entities correctly and in the right way, and we're not getting our fair share as developing countries, what it means is our countries have to find other ways to generate these revenues that they're missing out when they don't have the taxing rights to tax these multinational entities. So that's when then now we'll be fighting to say, no, you can't, increase VAT, you can't introduce more informal taxes because women are now have a more presence in the informal sector. So we will not have those conversations if our governments are taxing the right entities correctly and through because they've got the taxing rights to do so. So this is just basically just an expansion of the previous conversation on fair allocation to say what we are basically saying is that the old ways of taxing these multinational entities doesn't work anymore. We need new ways that go beyond physical presence in our jurisdictions, because whatever is there currently in terms of the international tax rules is outdated and historically imbalanced, and it favors the capital exporting countries or our investors, so to say. Because they come into our jurisdictions, they invest, then they take the money back to their countries, and they get more tax revenues compared to us who are providing the markets. And then also we need to change, permanent establishment rules. So what this just basically means for tax justice is that we need fair allocation to be able to support domestic resource mobilization, tax sovereignty. That means we want to be able to tax, to have our own rules, our own domestic tax rules, where we're able to tax those entities without the interference of unfair double taxation agreements or colonial double taxation agreements, so to put it. And then we're also saying that we want fair allocation because we want public services. And then we're saying that we also want the reduction of illicit financial flows, because all these things are very, very interconnected. So you might think, no, it's just a conversation about the fair allocation of taxing rights. But in reality, it's connected to so many things. It begins the conversation to so many other things, such as how to reduce illicit financial flows, for example. So basically, we want fair taxation of multinational enterprises. So I did refer to the double tax agreements. So currently, this is a sticking point in terms of the negotiations. So if you read the article, the current text of the article on fair allocation of taxing rights, you will find that there's an obligation that has been put there for countries or member states to renegotiate their double taxation agreements that don't align with the new nexus rules which we're trying to come up with, right? So you find that there's a lot of pushback there where global north countries are saying, look, it's the prerogative of the two countries, it's the prerogative of Kenya and the UK to negotiate this tax treaty. It shouldn't be something which must come in the international tax rules. The two countries can just agree what works for them. And the other thing is, what we need to think about when it comes to double taxation agreements is that not only have most of them been introduced before some of our countries gained independence, or soon after independence, before we're fully emancipated economically, but they are entrenching some of the unfair rules that are currently in the global tax system. So if you go into a double taxation agreements, you will find that what they do is they put their physical presence to say a permanent establishment. So Kenya can only tax where there's a permanent establishment. So most of our double taxation agreements, they entrench some of these unfair rules regarding physical presence or the unfair nexus rules, which takes away the taxing rights which our countries ought to have. So just for those that don't really know what I'm talking about when we say double taxation agreements, right? So when an entity is operating in two jurisdictions or even in three jurisdictions, but let me just say two jurisdictions, what happens is that to ensure that there's tax certainty, to ensure that we encourage cross-border trade, and that to encourage foreign direct investment, right? An entity or a taxpayer wants to know, how much taxes am I going to pay? Am I not going to be taxed in two regions? So to be able to avoid that double taxation, right, we need to introduce agreements. So countries introduce agreements to be able to regulate their tax relationship, or essentially their tax rights. So that's why this is a very, very important thing to consider if we're going to be making submissions in the upcoming negotiations, depending on whether or not the text that is going to come out for discussion changed anything regarding the renegotiation of double tax agreements. So this is something that's very important that we really need to understand. So I'm just re-emphasizing what is wrong with double taxation agreements, the role of bilateral and multilateral agreements. I explain what their purpose is to allocate taxing rights and prevent double taxation, is to provide certainty for cross-border investors, to limit tax competition through harmonization of taxes, revenue and competition risks. There's a lot of revenues that our countries lose because of this double taxation agreements. Like I said, it's about the fact that they lower withholding tax rates, and also the permanent establishment or the physical presence requirement, which they entrench. And then the issue that it also promotes a lot of tax avoidance through treaty abuse and treaty shopping by taxpayers. So the tension when it comes to double taxation agreements is when they're negotiated, or when they were negotiated, it's usually most of the time about focusing on attracting investment. So when investors want to come into your country, they want to know what they're really going to benefit from, from doing business or from investing in your country. So we tend to give them certain concessions to say, okay, instead of withholding, 20%, we're going to withhold 5% and so on. So it's linked to other sectors. It's linked specifically, primarily to investment. But then there has to be a balance between attracting investment and protecting our tax revenue or our tax bases, right? We shouldn't give away our tax rights because we want to attract investments. There should be a balance there. And then in the African context challenges there, hopefully you'll be able to draw a parallel with your own countries or your own country dynamics or contexts. When it comes to negotiating double taxation agreements, there's usually capacity constraints during the negotiation process. And then there's also power. This is a power thing. When you talk about the international tax system, it's about power. Like I said in the first slide, that this is about power. This is about politics, right? And then also the issue to do with limited resources for enforcement and administration. Although this is something that we don't go and say during the negotiations, to say, no, we don't have the capacity to implement the current tax rules, but there is capacity constraints when it comes to our revenue administrations, especially when they have to then work with DTAs that don't make sense. So if you Google right now, or if you could just go onto the internet, you see that there's a lot of litigation, specifically like in Kenya, there's a lot of litigation regarding unfair double taxation agreements. And this is also like an area which, as Tax Justice Network Africa, would do strategic litigation on, to say, look, this double taxation agreement really does not give a Kenya, for example, the taxing rights that it can get, or it ought to get. And then also about the double taxation agreements having to follow the correct process in terms of seeing whether or not they are in doing what they're supposed to do. That is, for example, attract investment. We can't just be giving away our taxing rights without having to get something in return. And then here I just try to explain the revenue losses that some of the countries are experiencing because of the double taxation agreements, or because of the fact that some entities are not taxed because they're not physically present in certain jurisdiction. So here you see that Kenya has foregone revenue of 432 million US dollars due to the UK Kenya DTA. And then you've got there Nigeria and the Netherlands DTA, where it lost 1.1 billion US dollars. So when we talk about why the fair allocation of taxing rights is the heart of the tax of the UN Tax Convention, is because this is where the conversation begins to say, okay, if you can't generate revenue from taxing multinational entities because you're losing your power through DTAs and other unfair bilateral treaties, then how are they going to make up for those revenues? How is Kenya going to make up 432 million US dollars? How is Nigeria going to make up 1.1 billion US dollars that it loses through an agreement? So then you'll find our countries struggling to raise the revenues that they need for public services. That's when you'll find then now we are in the streets as women to say, look, these taxes are not working for women. So this is what it's all about. It's very interconnected. So you need to understand whether your country is a source country or residence country. So when you leave this conversation today, just try to understand the positionality of your country. Is it going into the negotiations as a source country or as a residence country? What are you really fighting for? And then also just to analyze the double taxation agreements and understand how we're losing our taxing rights as developing countries through them, and how then it connects back to the fair allocation of taxing rights. And then just in terms of input, so after every session, there are inputs that are made. So these are some of the inputs which the Feminist Working Group put forward on Article 5 on fair allocation of taxing rights. So there was the issue of your value creation. We were saying that value creation is a concept that is very vague and very difficult to understand. Because how do we know where value is being generated, and how do we measure it when, across the different borders or across the different countries? And then also that there's no dedicated framework for multinational entities. And then also what fair allocation, what the nexus rules or the allocation principles should be, that besides physical presence, right? What else do we need to introduce to be able to tax multinational entities? Yes, other jurisdictions have introduced digital services taxes. Yes, they've tried to go around the very difficult and imbalanced international tax system. But then we need an international tax system. We need all to have ways of taxing multinational entities that come and provide services without physical presence. So we're still having that conversation as we go into the 5th session. And then also that there's no dedicated provision for extractive industries. So an extension of Article 5 is still the position. So for those that have not, I think, made a contribution in terms of a feminist tax analysis of the UN Tax Convention by joining onto the inputs that have been made by the Global Alliance for Tax Justice. I think it's very important to understand this specific article before we go into the other articles, to understand what our submissions are, and then we can then speak about other important articles after that. So I think this is my presentation for today. And I think just to summarize it and put it all together, number one thing that we need to understand when we're talking about a feminist tax analysis of the UN Tax Convention or a feminist approach is we need to understand that, number one, the domestic tax system interacts with the international tax system. For you to be able to say we need public services for health, for childcare, for education, those services that are very critical and important for women, we need to know that our governments need to be able to raise their revenues, and the only way they can raise these revenues is if they can be able to properly tax multinational entities who are operating in a different way compared to 15 or 20 years ago. And then we need to understand that if our countries cannot tax those multinational entities, the burden is falling on citizens and primarily on women, because they'll have to work with consumption taxes, they have to work with personal income tax, they have to introduce informal taxes. So they'll chase the easiest people or the low-hanging fruit. So us as women in this, in the different spaces that we work in, we are definitely the most affected because we don't have the same ability to pay as the other gender, and we don't have the same ability to bear the tax burden. So we need to be able to consistently uncover the hidden, the explicit, and the unintended consequences of our tax systems when it comes to doing work on gender and tax. So I think those are my final points, and I think that the thing, sorry, to emphasize is regarding double taxation agreements. Let's understand these will be dealt with in terms of the international tax system, because we can have a very beautiful UN tax convention, but then if we still have other agreements that are running parallel to that, which are entrenching or taxing rights from our countries, then we might not as well have done anything. So this is something important to think about and consider when you go into the next session. So just a quote there to indicate whose lives are affected when governments do or do not receive that revenue. So from a critical tax theory approach or from a feminist tax analysis, whose lives are affected when governments do or do not receive that revenue? I think the answer is very clear. Thank you very much.
Thank you so much, Zandile, for that very informative and very insightful presentation. I think it has really helped in terms of all bringing us to the same page in terms of understanding fair allocation of taxing rights and what the core issues are and what our asks need to be, especially when it comes to the negotiations. I'd now like to invite any questions or comments. Please share them in the Q&A box. If you prefer to speak, you may also raise your hand. I think it will be possible for us to unmute and allow you to speak. But maybe just to share one of the questions that has come in from Maria. She's asking, which countries are pushing for this preferred drafting of Article 5? I don't know if that's clear for you. If it's not clear, then maybe Maria could.
Sorry, you said which countries are?
Which countries are pushing for this preferred drafting of Article 5?
So it's mostly developing countries. I can't name the countries from the top of my head, but because of because I interact more with the Africa group, I will just say the Africa group countries are pushing more for a proper fair allocation of taxing rights, or for an article on the fair allocation of taxing rights.
Thank you. I see Maria's hand is still up. Alex, is it possible to unmute her?
Sure. Hi, thank you. Thank you very much, Zandile, for the presentation. So just like and for answering this question, a couple of things, because you're absolutely right that the taxing rights and the drafting of the Article 5 is key, and you were also talking about the double tax agreements and how they have been really unhelpful, let's put it like that, at least to tax in a fair manner. And this is one of the key articles that are being debated as well. So Article 15 and how this convention, like framework convention, actually applies to the current DTAs. So just a couple of things. So how much are countries actually buying into the wording unitary taxation? Because in previous negotiations, although they have been moving to include sales and workers and other factors, and just trying to move. It has been more perhaps CSOs, like moving away from the value creation. Although some countries were talking about that, the actual wording unitary taxation, how much is it being used? And then the second question has to do with how the countries, how are they pushing, particularly the African countries, for this framework tax convention to either supersede, either to ask countries to review double tax agreements, or how it's working in terms of a hierarchy, and what are the key things to be looking at for these August negotiations. Thank you very much again.
Thank you for that, Maria.
Should I take that one, Grace?
Yes, you can.
Okay. Okay, thanks, Maria. So I think on the unitary taxation conversation, I think that one is it's still ongoing, and in terms of what we're just trying to do, I think as ATAF, AU, the African Union and TGNA, is to try to develop like research around unitary taxation, because when you engage the negotiators, you find that they'll be like, okay, we understand that maybe we need another system that works apart from transfer pricing, but then they're not yet ready to really have that deep unitary taxation conversation. And we're hoping that through our research, we're going to be able to then convince them to say, look, maybe unitary taxation can actually work and how it can work. And also, we're going to discuss the issues to do with withholding taxes as well, gross withholding taxes, and DSTs and significant economic presence, and all of those other conversations which are not really coming up during the negotiations, but specifically unitary taxation. So I'd say we're still trying to find our feet on that one. And then on value creation, so if you read all the current proposal specifically for the Africa group, you'll find that they still include value creation there, in addition to market users and the other, allocation keys that they want to be used. So they haven't done away completely with the value creation. So we're hoping that probably when they go into the next session, they'll have a real look at, the value creation concept or aspect and try to work around it. And then on the issue of superseding or reviewing DTAs, I think that one, they're really, really pushing for it. Initially, they're like, no, they want the UN Text Convention to be a fast track instrument. So whatever doesn't align with the UN Text Convention, they do away with. They do away with it. So this is something which they've been constantly saying throughout the negotiations, that no, we need an instrument that will then allow our countries to renegotiate whatever double taxation agreements don't align with the new international tax standards. So that one is a key area or a key focus area for the Africa group specifically. So yeah, so I don't know if I've left out any question, Grace. Yeah, on the first one, you said which countries are pushing more for an article on the fair allocation of taxing rights. So I would say developing countries are pushing more on this specific article because it obviously means more for source jurisdictions, which are mostly developing countries than for the global north countries who are going to lose a lot of revenue if this article contains new allocation rules, or it gives source jurisdictions more taxing rights. So I'd say source jurisdictions are really pushing for this article because it's very important for them to be able to tax multinational entities beyond having that don't have physical presence in their jurisdiction. So yeah. So I don't know if I've been able to answer you, Maria.
Okay. So there's one last question in the chat from Nema, who says, given that women constitute a significant proportion of self-employed informal workers, how can the UN Tax Convention encourage governments to use additional tax revenues to strengthen social protection, access to finance, and decent work for this group? It's in the chat.
All right, let me just quickly read it, given that women constitute. Okay, so for this one, Nima, so I think the relationship between the international tax system and the domestic tax system needs to be understood. There's a link between those two. So what the UN Tax Convention is going to do is going to give our countries, or source, not our countries, let me say source jurisdictions, because we're not all from source jurisdictions. So what they'll do is what the UN Tax Convention will do in terms of this article on fair allocation of taxing rights, to give your country the rights, or greater rights, or source countries greater rights to be able to tax multinational entities and generate more revenues. And the connection then with our domestic tax systems is that if our governments can collect more from multinational entities, it means that they'll rely less, or we can argue then that they can rely less on other forms of taxes, such as personal income taxes, or such as informal taxes, because women are more in the informal sector, right? Then now we can make the conversation about, okay, since now you can collect more revenues from these multinational entities, it means then you can give us more in terms of social protection, in terms of health, in terms of every other public service that has a direct effect on women. And then we can also argue for them to then say, look, since you can collect more from multinational entities because you've got those taxing rights from the UN Tax Convention, that means then you don't need to tax the informal sector the way that you've been taxing it. And then that means now women can say, look, we're in the informal sector more, you are taxing us more. So I think that's my answer to that one.
Thank you for that, Zandile. And I see our time is fast spent, so we definitely need to bring this to a close. But just to note, in terms of the next steps, we hope to have this inform our positioning as feminists who are working on the UN Tax Convention. We hope to frame a positioning around the fair allocation of taxing rights. And just to also let you know that this is definitely the first of a series of webinars that we will be holding on specific articles of the UN Tax Convention to give us a deeper understanding and also allow us have a common positioning and around these specific articles. So you are welcome to interact with more information when it comes to the UN Tax Convention on the GATJ website. They have quite a lot of resources, and TJNA as well has resources, and all our different organizations, just to also inform us and allow us have more interaction with the UN Tax Convention. Please keep engaged, especially with the Tax and Gender Working Group, where we are increasingly fronting and having more of these discussions. And we look forward to having you as part of the next webinar. Please be on the lookout for the poster and the link to register. And thank you all very much for joining this session. And thank you, Zandile, for the wonderful presentation and guidance throughout the session. Bye, everyone.